wanna sleep in, cause I got something to prove. I gotta take what I...
Do you have questions about starting a trucking business? Box truck or CDL, I've done both. I can help you start your trucking business or grow your business so that you can buy more trucks. Use the link in the description to schedule a one-on-one consultation with me. Now let's get to the video. Hey, this is Zach Pasquarello. Good, how are you? Do you have specific questions? Do you already have your DOT authority? So you have a Sprinter van, you've already been driving it. Are you working for another company or who's paying you? In what state do you live? So registering a business is a fairly simple process. You basically just go to your state's Department of Revenue website. At least that's how it is in Pennsylvania. And I'd imagine most states are the same. So you just go to your state's Department of Revenue website and you just register your business. Or maybe it's the Department of State. Either one, either Department of Revenue or Department of State. If you just look up like Maryland setting up business LLC on Google, it'll probably take you to the first website that you need to go to. You should be able to do it all online. I know for Pennsylvania, all we do is we pay $70, we fill out 2 forms, we wait 2 weeks for the Department of State to review our application, and then we have our articles of organization for our LLC, and we are a legitimate business. It's a 2-week process, super simple, $70 in Pennsylvania. I think most states are pretty similar. You can do it yourself, or you can hire an attorney to do it for you, but you're gonna pay them probably $300, $400, $500. Yes, that's a good question. So whenever it comes to filing your taxes as a business entity, the IRS recognizes 4 entities. You have a sole proprietorship, a partnership, you have an S corporation, and you have a C corporation. So C corporations are big publicly traded companies. You do not need to be a C corporation. A partnership, anytime you have a business with more than one person, you have to have a partnership. So is it just you or is it you and a partner? Okay, so for tax purposes, first of all, for legal purposes, whenever you're filing your business entity with your state, you can either be a sole proprietorship or a single member LLC. I always recommend just become a single member LLC because it just separates your business from your personal entity a little bit more, and it's not that much more paperwork. So I always recommend just go for a single member LLC. Now the question is whether or not you want to be taxed as an S corporation. Very different to elect to be taxed as an S corporation. So either way, you are a single member LLC, but you can elect to be taxed as an S corporation. However, I never recommend anybody do that until they make $80,000 of net income. So if I were you, just register with your state as a single member LLC, wait 1 year, maybe 2 years, establish your business, figure out how much money you're making. And then once you start making more than $60,000, I recommend you consult with a CPA or an attorney and ask him or her if at this point it's beneficial to elect to be taxed as an S corporation. But don't do it now, just wait a year or 2. Right, so you used your personal money to purchase your van, and now you need to recognize essentially your business asset as a legitimate business expense. It does not matter if the name is registered in your name, or if the van is registered in your name, or if the van is registered in your business name. As long as you are using that van for legitimate business purposes, it is 100% a tax deduction. With vehicles and assets, they depreciate over 5 years. So if you go out and spend $60,000 on a van today, you're not able to have a tax write-off of $60,000 today unless you do special things like bonus depreciation or Section 179, and those are more complicated topics. I'm just talking about straight line depreciation. So the IRS has given a useful life to commercial vehicles of 5 years, which means in the eyes of the IRS, you as a business owner should be able to use this van for 5 years, which means you have to recognize the expense of the van over the course of 5 years. Like I said, if you go out today and buy a van for $60,000, you are not able to subtract $60,000 from your income in the year of 2022. What you have to do instead is divide that $60,000 by 5. So every year for the next 5 years, you will be able to take a $12,000 expense, and it's called depreciation. Like I said before, you can do special things like bonus depreciation or Section 179. However, doing those things requires a consultation with a CPA whenever it comes time for you to file your taxes. So what you can do theoretically with Section 179 is you could depreciate the entire expense of that van this year and subtract $60,000 from your income. However, I always caution people when they do that, if you do that this year, that means for the next 4 years, you cannot take any depreciation on that vehicle. So the reason I caution people is because you should make more money in your second year of business. You should make more money in your third year of business. So I always recommend just take the $12,000 depreciation deduction this year, and then next year you can take bonus depreciation, or the next year you can take bonus depreciation, but just do straight line depreciation for the first year in business. So back to your original question. Yes, even though you bought the van with your personal money, you can still 100% capture the entire expense of the van through depreciation, as long as you're using the van 100% legitimately for your business. There is a special way to recognize these business expenses that you incurred on your personal account. There's a couple different ways to do it. You can do it very easily through QuickBooks. That's the best accounting software to categorize your expenses and your income and generate your profit and loss. It's kind of difficult to theoretically explain how to do this. It would be a lot more simple to do like a Zoom screen share and show you how to do it. But essentially, you're just going, so it's called owner's investment. Whenever you take your personal money and invest it into the business, you can do it one of two ways. You can take $10,000 cash from your personal account and put it into your business checking account, and we will have on one side $10,000 of owner's investment, and on the other side we'll have $10,000 of cash in your business checking account. That's the traditional way to recognize owner's investment. The non-traditional way, which is what most people do, which is what you did, because most people don't have a business checking account, they'll take their personal money, $10,000, and they'll spend it on their business. So we're taking $10,000 of equity, owner's investment, and then we're going to recognize $10,000 of expenses, which is going to flow through your profit and loss statement. But either way, as long as you have a detailed description of all of those transactions, you can absolutely still recognize them as business expenses, theoretically. But the way we do it, like actually with QuickBooks, would require like another 30 or 60 minute kind of coaching consultation session, because it's more difficult to do it in practice. But theoretically, absolutely, just because you used your personal account to recognize as business expenses, like they're still legitimate. You can still write them off at the end of the year for tax purposes. It's super simple. All you need to do is have an Excel spreadsheet with all of these transactions, and you only need three things. You need the date, a brief description, and the amount of the expense. So January 1st, 2022, you went to Walmart and got office supplies and you spent $100. That's it. And you need to put it into an Excel document, and then you can import that Excel document directly into QuickBooks, and all the information is there. You don't need to manually enter one transaction after another. You just import that Excel spreadsheet directly into QuickBooks, and then it's all automatically there. It's super simple, and I can walk you through how to do that whenever you get QuickBooks and whenever you get to that point. Yeah, I can definitely show you how to use QuickBooks. I won't be able to show you how to do it in the next 10 minutes, but probably in 30 minutes or 60 minutes, I can definitely show you how to use QuickBooks. And all you need to do is get the Excel document prepared, and then I'll take it from there. So I can show you how to sign up for QuickBooks. I can show you how to get started. I can show you how to import all of these transactions into QuickBooks. I can show you all of that. All you need to do is just get the Excel document prepared, and then I can do the rest. And then once we get the business checking account set up, then we can connect that account directly to your QuickBooks, and then you don't need to do Excel. All of the transactions are automatically pulled straight from your business checking account into QuickBooks. It's so simple. I don't know if you need to do that, but I do know 1000% you need to pay your taxes. And you need to tell the IRS, if you made $100,000 this year, you definitely need to tell the IRS that you made $100,000 this year. That's the most important thing. Like, there are serious penalties, potentially jail consequences if you don't tell the IRS how much money you make. So that is hands down the most important thing. But when it comes to registering a specific business entity with the state, that's not always required, because there's a lot of just 1099 independent contractors who don't necessarily have a business. They're just a person working for another company. So if that's you, then you don't technically need to have like a legitimate limited liability company registered with the state. I don't know for sure about that, but I do know you need to pay your taxes.